So students of financial reporting and analysis, remember it's another perfect time. We continue with our sessions. We continue with our sessions. So we are going to look at this sitting question for the published financial statements. So that is published financial statements for December 2024. December 2024, question 4. Remember that I have already introduced what you need to understand under the published financial statements, of which you know that as per IAS 1, we have those statements like statement of profit or loss, statement of changes in equity, statement of financial position, and the cash flow statements which are prepared. So for us to address the issue of IAS 1, to start with, I will do that question, of which it will cover the concept of preparing the statement of profit or loss, statement of changes in equity, and the statement of financial position. So this is the relevant question which I will be able to share on your screen. So this is the relevant question for December 2024. And they are saying that Farmland Limited has been in operations for past 15 years, dealing in agricultural produce processing business. The foreign trial balance was extracted from the books of the company as at 31st October 2024. So you can see we have various items: revenue, income from investments, ordinary shares, retained earnings, 8% loan stock, accounts payable, deferred tax, bank balance, land and buildings, plant at cost, accumulated depreciation for building and plant, purchases, distribution cost, administrative expenses, loan interest paid, leased, plant rental, dividends paid, inventory. That is 1st November 2023. So that is opening, because our financial year ends on 31st October 2024. Then you are given inventory as at 1st November 2023. That is an opening inventory, the opening stock. Accounts receivable, then we have investment, the long term. Additional information number 1, as at 31st October 2024, the inventories were valued at 43.2. So this is the closing inventory. Number 2, the land and buildings were purchased on 1st November 2008. The cost of land at the date of purchase was 70 million. However, on 1st November 2023, the land and buildings were provisionally valued at shillings 175 million and the shillings 80 million respectively. The estimated useful life of the building before evaluation was 50 years. However, the evaluation did not change the useful life of the building. Plant is depreciated at 15% per annum using the reducing balance method. So I will look at this note 2. We check if there is any revaluation gain. Then we check for depreciation of that plant based on the percentage given there. Based on the percentage given there. Depreciation, remember that depreciation is an expense. They went ahead to say that depreciation are to be included under cost of sales in the income statement. So they are very specific that once you compute your depreciation, when classifying them based on the various functional heads, remember that I said when you are doing published, your expenses goes to either cost of sales, administrative expenses, distribution cost, or we talk about finance cost. Here they are very specific that depreciation goes to the cost of sales. Number 3, on 1st November 2023, Farmland Limited entered into a 5-year lease agreement for an item of plant. This item had an estimated useful life of 5 years. The annual rental, which was payable in advance with effect from 1st November 2023, was 22 million. The fair value of the plant is 92 million, and the implicit interest rate is 10% per annum. Number 4, the 8% loan stock was issued on 1st January 2024, and the interest is payable 6 months in arrears. The income tax for the year ended 31st October 2024 is estimated at 28.3. It's estimated at 28.3. The deferred tax provision as of 31st October 2024 was to be increased to 14.1 million. So statement of profit or loss, statement of changes in equity, statement of financial position. So that is 20 marks. 8 plus 4, 12. 12 plus 8, 20. Those are the 20 marks. So for published, the first thing you do is the workings. You have to do your workings. First, it's not like consolidation. The one I was just doing what is required as we continue with the workings. Here, I need to check some few workings very fast. Even if workings doesn't earn you any mark. So we have to do the workings very fast. Then from there, once we are done with the workings, we can do the presentation. We can do the presentation. So remember that we start with workings. So workings. So which I have working number 1, WK1. So additional information number 1, it was concerning what? Closing inventory. No working there. There's no working for that. But for additional information number 2, let me open the soft copy on my phone so that I avoid sharing on the screen, because already you have the past papers. So it's better I open it from my end also, so that it can be easier. It can be easier in communication. So anyway, as I wait for it to open, I remember additional information number 2, there was a revaluation which was done. So we need to check for revaluation gain or loss. Revaluation gain or loss. It has opened. So additional information number 2, they did a revaluation. Land and buildings were purchased on 1st November 2008. The cost of land as at the date of the purchase was 70 million. However, on 1st November 2023, the land and buildings were provisionally valued to 175. So we need to check for what? For evaluation gain or loss. Evaluation gain or loss. So here we have land and we have building. It was land and buildings. So shillings in thousands. Shillings in thousands. So remember that we start with the revalued amount. Revalued amount. These two were revalued to 175. That is what they said. The two are, they said, the land and buildings were provisionally valued at 175 and 80 million respectively. So this one is 175,000. It was valued at 175, and this one is 80,000, and that one is 80,000. So that is revalued amount at what? The revalued amount at fair value. That is what I have recorded based on additional information number 2. Based on additional information number what? Number 2. And we compare with the carrying amount. We compare with the carrying amount. Remember, the carrying amount is the same as book value. The book value. So if we look at our trial balance, the land and buildings were stated at 270,000. Land and buildings. Land and buildings were stated at 270. Of which, did they mention one of it was stated at which value? In note 2, the land and buildings were purchased on 1st November 2008. The cost of land as at the date of purchase was 70. The cost of land was 70. The cost of land was 70. Remember that the land doesn't depreciate. But now for building, for us to get our carrying amount, remember that carrying amount is cost minus what? The carrying amount is cost minus depreciation. So building, we have to consider depreciation. Remember the total amount was 270, on which we have the cost of land is 70. Meaning that the building is 200,000. But the cost is 200,000. But now we have to minus what? Depreciation. The depreciation as per the trial balance, the accumulated depreciation is what? 60,000. It's given in the trial balance. So 200 minus 60, that is 104, 40,000. So this one was stated at 70. It has been revalued to 175. So that is a gain of 100 and what? 105,000. This one was at 140. It has been revalued downwards to what? To 80. It has been valued downwards. So these are evaluation laws. Evaluation laws of C60. Evaluation loss of C60. So that means total evaluation gain will be, because we have a gain of 105 and we have a loss of 60. A gain of 105 and a loss of 60. That one will be a evaluation gain of 45,000. Evaluation gain of 45,000. Remember that this one goes to other comprehensive income. This goes to other comprehensive what? To other comprehensive incomes. And also it has to appear as an equity in the statement of financial position. It has to appear as an equity in the statement of what? In the statement of financial position. Then they gave us 15%. 15%. Plant is depreciated at 15%. But before that, before we talk about plant being depreciated at 15%, remember that for building, the estimated useful life of the building before revaluation was 50 years. Was 50 years. Was 50 years. However, the revaluation did not change the useful life of the building. The useful life of the building. So from November, this one is from November to 8. From 1st November 2008 to this time when this revaluation was taking place, 1st November 20 what? 2013. How many years are those? How many years are those? 2013 minus 28. So the cost of the land, they say that the higher one 1st November 2003, not 2013, 2003, sorry, 2003. On 1st November 2003, the land and buildings were provisionally valued at 175 and 80. The estimated useful life of the building before revaluation was 50 years. However, the revaluation did not change the useful life of the building. So 2003 minus 28. Those are 15 years. Those are 15 years. Those are 15 years. So for me now to do the depreciation of building. Remember that here I will take, it was revalued to 80,000. Divided by how many years? Divided by 35. After revaluation, we use the remainder. We use the remaining years. We say 50 minus 15. 50 minus 50, 15. So we use the remaining useful life, the remaining after revaluation. So once revaluation takes place, when you are doing your depreciation, use the remaining years. Remaining years. So that's what I'm saying. I deduct 15 from 50. So 80,000 divided by 35. That is 2286. 2286. 2,286. So that is the depreciation for building. And for plant, remember it was at 15%. On reducing or what? Yes, reducing. So for reducing, remember you have to take your cost minus what? Cost minus accumulated depreciation. Cost minus accumulated depreciation. Cost minus accumulated depreciation. The plant is stated at a cost of 156. You have to minus accumulated depreciation of 26,000. Once you do that, you multiply with your 15%. So 156,000 minus 26, which is accumulated depreciation, times 0.15. You get 19,500. So they say that when we will be classifying these expenses, they go to where? To cost of sales. That is what they said. They go to cost of sales. We look at note 3. On 1st November 2003, farmland entered into a 5-year lease. 5-year lease agreement for an item of land. The item had an estimated useful life of 5 years. The annual rental, which was payable in advance, very important. The annual rental, which is payable in advance, not in arrears, in advance, with effect from 1st November 2003 was 22 million. The favor of the plant is 92 million, and the implicit interest rate is 10% per annum. So we have to do the analysis of this lease, the analysis of this what? Of the lease. So we have to write something here. We say since, remember this one was working 1, we have done this up to this point. So let's do working number 2. So say since the lease payment, since the lease payments are made in advance, since the lease payments are made in advance, the lease payments are made in advance. We can even be specific and mention the date, which is 1st November 2003. Since the lease payments are made in advance, we need to adjust. We need to adjust the payment schedules. We need to adjust the payment schedules. To reflect this. This means, what does it mean? This means the payment, on 1st November 2003 will not accrue. It will not accrue interest. It will not accrue interest and will be treated. This is very important. Will be treated. And this one will be treated as separate. It will be treated as separate initial payments. This is more of FM. This is more of FM. Financial management. So here you use this formula, right? So we say the present value. I can just say PV, present value. So you understand? PV, the present value of future lease payments will be this, of future lease payments is equals to the relevant principal times. So that is 1 plus 1 minus 1 plus R, raised to what? To N. Of this one, we have to divide with the interest. R is the interest. N is time. N is the time. And this is time, this is interest. And so that is the formula we use. Then we say the BV, the present value, for the first That one was the only, but that was the only challenging additional information. So, but you will be able to understand. The present value of the first payment is, so in that question, it's the BV of the first payment will be on 1st November 2003, farmland entered into a 5-year lease agreement for an item of land. The item had an estimated useful life of 5 years. The annual length of which was payable in advance with effect from 1st November 2003 was 22 what? 22 million. It's 22 million. The present value of the first payment is 22 million. Then now for the other, it would be 4 years. For the other 4 payments, because it was 5 years, for the other 4 payments, we calculate the present values, calculate the present value of those payments. So how will this be done? So we have said that the present value of the first payment is 22 million. So for the other 4 payments, we calculate the present value of those payments. So how would that be done? So here I will come and say the 22,000 times present value. Now, present value, interest factor. Present value interest factor. Remember that the interest is 10%. That is what they gave us for the 4 years. Now for the other 4. For the other 4 years. So it's equals to, so we say 22,000, the initial payment, times 1, remember that I'm applying this formula, minus 1 plus R. R is 10%, which is 0.1. Raised to time, which is 4 years. The other 4 payments. Calculate the present values of those payments. Divide by what? You divide 0.1. So you get what? So doing that, what are you getting? You use your calculator well. 1 plus 0.1, that is 1.1. Lest you raise to negative 4. 1 minus answer. Divide by 0.1 times 22,000. So I'm getting 69,737. 737. And I will come here and say, well, this is now the right to use asset. This is finance. This is leases. So right to use the asset, right to use. So the risk liability was Risk liability is this one, 69,737. But now the payment in advance, the initial one. The initial one is 22. Payment in advance is 22. So that is why I said that since the risk payments are made in advance, we need to do what? Adjust the payment schedules to reflect this. This means that payment for 1st November 2023 will not accrue what? Interest, and it will be treated as separate initial payment. So the total will be right to use the asset, so 69 plus the 22, the initial one. It will be 91,737. 91,737. So the 91,737. The 91,737. Then after that, we check for depreciation. Depreciation of that leased plant. Depreciation on leased plant. So which is equals to? Remember that the years we know is 5. Eh? The years are 5. So 91,737 divided by what? Divided by 5. You get what? You are divided by 5. You get 18,347. 47. 18,347. 47. So that is that was the only challenging. That one was the only challenging additional information. All right, what about the others? The other additional information? Additional information number 4, the 8%. So remember that this one was working number 2, not 1, working 2. So we go to working 3. So 8% loan note. 8% loan note. So they have said that, but this one even it doesn't have a lot of workings. So the 8% loan was issued on 1st January 2004, and the interest is payable 6 months in arrears. 6 months in arrears. Interest is payable 6 months in arrears. So the value of the loan is value of loan. So if you look at your trial balance, the loan is stated at 50,000. So you need to know the interest. The interest. So the interest is payable 6 months in arrears. But now this loan was issued when? 1st November 2004. So from November, it was issued on January 2004. From January to the end of the year, those are how many months? 10. So I come here and say 8%. The interest will be 8% times 50,000 times what? The period. Remember that this loan was issued on January. Our financial year ends on October. So from January to October, those are 10 months. So 10 over 12. That is it. That is the interest. So 10 months. From January to the end of the year, 10 months. 0.08 times 50,000 times 10 over 12. So that is 3333. 333. Last but not least, so the income tax for the year ended, that is not 5. The income tax for the year, ended at 1st October is estimated to be 28.3. Deferred tax provision was increased to 14.1. Remember that when you are talking about tax, you have to consider both current tax and deferred tax. But for the deferred tax, we check what? Increase or what? Increase or decrease. So we always say that your income tax, you always see this. This is working for. Your income tax, you have to consider your current tax plus increase plus minus. Increase or decrease. Increase or decrease in deferred tax. Increase or decrease in deferred tax plus tax under provision for the previous year minus tax over provision. This one is for the previous period. The and over from the previous period. If there was under provision from the previous period, we add. If there is a over, we minus from the previous year. If there is under provision of tax from the previous year, you add it to the current year tax. If it's an over provision from the previous year, we minus. So looking at our additional information number 5, income tax for this is estimated to be at 28. So that is the current. 28, 300 is the current. Plus, so Increase or decrease in deferred tax. They said deferred tax as at 31st October 2024 was increased to 2. Was increased to 2, not by 2. So from where? If you check on your trial balance, you have a deferred tax. It must be there. Deferred tax under the trial balance is bonus here. Equal. It's 33 what? From the trial balance. From the trial balance is 12,500. Then it has increased to 14,100. So the increase is, the increase is 1,600. That is what you add here. There is no under provision or over provision from the previous year. It's not present for this question. So 28,300 plus 1,600. So that is 29,900. 29,900. Then we said that expenses are supposed to be classified under what? Cost of sales. So working file. Some expenses goes to the cost of sales. Some goes to admin. Some goes to distribution. I will not include finance cost here because finance cost contains only interest. So some expenses goes to the cost of sales. Some goes to admin and some goes to distribution. Some goes to distribution. Some goes to distribution. And there's something I never did for, remember this working, there's something I will do. Anyway, this one we never finished. So there's something, I need to do a risk amortization schedule. So we never did a risk amortization schedule. For us to determine the interest, short-term liability and long-term liability. So remember that after doing this, we need to do a risk amortization schedule. That is all. I never did that. So we need to do a risk amortization schedule. Because why am I doing this analysis? So once we do a risk amortization schedule, I will be able to determine the interest, the short-term liability and long-term. Because interest goes to the income statement, short-term liability, under current liability, long-term liability, and a non-current liability. But before we do that, let's just classify some of the expenses under the cost of sales, admin, and distribution. So we start with the balance brought down. So do we have a cost of sales? If we don't have a cost of sales, you know how to determine it. Opening stock plus purchases minus closing stock. Opening stock plus purchases minus the closing stock. Opening stock was opening inventory. Opening inventory is 37,800 plus purchases. Opening cost of sales is opening stock plus purchases minus closing stock. Opening stock is 37,800. Purchases. What's the purchases? 78,200 minus closing. Closing is 43,200 from note 1. So cost of sales is 72,800. Opening stock plus purchases minus closing stock. For admin is 5,500 from the trial balance. And the distribution is 10. So which are some of the expenses which are classified under the cost of sales? The only expenses we have is depreciation anyway. We don't have another expense. So we have distribution for the building. So depreciation for the building was building, plant. We have the plant and the leased plant. So the building, remember they said that this depreciation goes to the cost of sales. The building was 2286. Yeah. For the plant, other than list the plant, for the list the plant, I can see it's 18,347. What about for the other plant? It was 19,500. Eh? Then we have this one is 18,347. So there is no another expense. Those are the only expenses. Here we have 5,500. Here we have 10,000. So 72,800 plus 22,86 plus 19,500 plus 18,347. So this is 112. That is 112 watts. So this is 112. According to my calculator, it's 112, 933. 933. Right. So let's finish this working. We never finished this. After doing this, we needed to determine the interest. So I will clear this. Here. I needed to do my analysis. So I needed to determine the interest, short-term liability, and long-term liability. So for us to do that, we need to break down the lease liability at start of each year, starting with 1st November 2003. So in short, we need to do lease amortization schedule. So we need to finish with the lease amortization schedule. Yeah, we needed to do a lease amortization schedule. Starting with what? 1st November 2003. But our books are prepared 2004. So it will be just the start of 2003 and the 2004. So the period will be 2. I don't have to do the 5 years because our books are prepared by 2004, of which the payments are done in advance. So as at the start of 2003, which is 1st November, so we have 2 periods, 1st November 2003 and 1st November 2004. So periods, the periods are just 2. Those I've said, our books are prepared by 2004. They are prepared by 2004. I don't have to do for the entire 5 years. I don't have to do for the entire 5 years. So the balance brought down is this 69. The 69, 737. 69, 737. 737. So here the payments. So there's something I said that there's something we said that in our notes that since the lease payment are made on advance, we need to adjust the payment schedule to reflect this. This means payment on 1st November 2003 will not accrue interest and will be treated as a separate initial payment. So this one will be treated as a separate. That is why we'll have dash. I think you need to understand this well. This means payment on 1st November 2003 will not accrue interest and will be treated as a separate what? Separate initial payment. Separate initial payment. So I will have dash there. So that here the balance is 69, 737. 69, 737. Then interest, remember that interest is at 10%. 10%. So it'd be 69 what? 73. 69, 73. So that balance carried down here will be so 69, 737 plus 69, let's say 69, because we round off, let's say 69, 74. 10% of these, 6974 plus 6974. That is 76, 711. So that is what opens here. 711. Original here we have 22. Now for the second year, we'll consider 22. The second period, 22,000. So that the balance will be so minus 22. 54. If you deduct this from here, is 54, 711. And here is 54, 71. So 54, 711 plus 54, 71. So this is 60, 182. So that is it. So when I will be doing my statements, remember that interest will be, the interest for this is 69.74 plus, there was that interest for loan, it was 3,333. So 333. So it's 69.74. Because now this is the one paid in the second year, because we have taken this, added this, we have brought this here, then we have paid something. That is what I'm saying is 69.74. Plus the one for loan. This one is for the loan. We did this. And this one is from the loan. So our total interest will be 10,307 to the income statement, to the statement of profit or loss. Then what about the short-term liability? What about the short-term liability and the long-term liability? So the lease obligation, the lease obligation. So we have to talk about short and long-term. Short-term and long-term. That one would appear under the statement of what? Statement of financial position. So the long-term, which is payable after 1 year, will be, anyway, let's first start the one which is paid immediately in this year. Remember, 22 is paid in advance. Once they open that year, 22 is paid in advance. A liability paid for a period not exceeding 12 months. Remember, this one is paid in advance. Then now the balance of 54 will be paid in the next financial year. That is after 1 year. The balance of 54, 711 will be paid after what? After 1 financial year. Will be paid after 1 financial year. So this question is like it's like we have done everything. Presentation is very fast. There's nothing we have not done. We have done everything. Now it's just the presentation, and the presentation is what is marked. Now it's just presentation. The presentation. So I will come here and say farmland. I will come and say farmland. Statement of what? Statement of profit or loss. And other comprehensive incomes. So remember there was revaluation. Revaluation is other comprehensive income item. Another comprehensive income. So that is for the year. For the year ending, our financial year was ending on October 2004. It was ending on October 2004. So we have shillings in what? In thousands. So we start with revenue. Tell me, which is the revenue? The revenue is 278,400. Less cost of sales. Now you raise this cost of sales. The 112,933. Now you understand why I was doing this working? So that you get your gross profit here. Get your gross profit. After gross profit, there's income. There's investment income. Investment income. I saw it somewhere. Income from investment. The income from investment was 4,500. There is no another income. Less expenses. That's your expenses. So the expenses we have admin. This one was given direct. There is no another expenses included here other than the 5,500 given from the trial balance. Distribution. The distribution cost is 10,000. The distribution cost is 10,000. Then finance cost. Already we know the finance cost. We have done that. 10, 307. So up to that point, we have the profit before what? Profit before tax. We know the income tax was. We did our working. Income tax it was 29,900. Remember, we considered the current tax and the deferred tax. So that we have the profit after tax. So 278, 400 minus 112, 933. So this is 165, 467 plus 4,500 minus 5,500 minus 10,000 minus 10,307. So that is 144, 160 minus 29,900. That is 114, 260. 114, 260. Add other comprehensive incomes. We have revaluation gain. The revaluation gain, I think it was 45,000 for the run and buildings. Total comprehensive incomes. The total comprehensive incomes will be plus 45,000. 159, 60. All right, so we do statement of changes in equity. So it comes and say farmland limited. Statement of changes in equity. Statement of changes in equity. That is for the year ended 31st October 2004. So I will include all items so that you understand the format for this. I will include even the items which are not there. We have ordinary share capital. We have share premium. But for this question, I will deal with what is present, but I would just draw the entire format. Share premium. We have a revaluation reserve. RR is revaluation reserve. And we talk about retained earnings. Then we can have a general reserve. Yeah. And we have total. So remember that here we always start with balance brought down. For what you have, if you have ordinary share capital, share premium, evaluation reserve, retained earnings, general reserve. So if you look at this question, we have which equity components? If you look at your trial balance, which items do you have? We only have three. We have ordinary share capital, you can see retained earnings, and in the additional information, there's revaluation. So ordinary share capital is 150. This is not there. Revaluation reserve, we don't have balance brought down. Profit, retained profit. Retained profit was the one given, 119. From the trial balance, 119, 500. We don't have general reserve. So 150 plus 119, 500. So that is 269, 500. So then you ask yourself, was there issue of shares? Was there issue of shares? So issue of shares at par, and at some point you can have at premium. Remember, at par goes to the ordinary share capital. At premium goes to the column of share premium. So you take it to the total there. So it can be at par and at premium. At premium goes to share premium. At par value goes to the ordinary share capital. Then the next thing you check, you can have a revaluation gain. A revaluation gain. There was a revaluation gain, which goes to the revaluation reserve. So there is a revaluation gain of 45,000. And it goes to the total. And another thing you need to ask yourself, was there profit? Profit for the year? The one you have here, that is profit after tax. It is 114,260. It goes to the retained earnings. 114,260. 114, 200 and what? 260. After that, you need to ask yourself two things. You need to ask yourself two things. If they are present, you include. These two things are, is there dividends paid? Dividend paid. There was dividend paid. Dividends are paid out of what? Dividend is paid out of profit. So it goes to the retained earnings. You reduce your retained earnings. You reduce your retained earnings. Dividends paid was 15,000. From the trial balance, we have the 15,000. So we have 15,000 here. Then finally, if there is any transfer to general reserve, transfer to general reserve to chair. So some point you could like to reserve some amount. So you will be told, for example, they transfer something from the retained earnings. You minus, you add to general reserve. So and that is how the statement of changes in equity looks like. This is how it looks like. So balance carried down here. So we have 150,000 to statement of financial position. Yeah, we don't have anything. We have 45,000. This balance goes to the statement of financial position. These, So retained earnings is 119, 500 plus 114,260 minus 15,000. So that is 218,760. Yeah, we don't have anything. So that the total, that one will be the total will be 413. I think it's 413, 760. So that is how the statement of changes in equity looks, right? It shows the changes in the equity components: ordinary share capital, share premium, revaluation reserve, retained earnings, general reserve. I've tried to fix everything which can be present when you are doing this statement. So at least you understand even the format. At least now you understand the format. So last but not least, we do the statement of financial position. But now, before we do the statement of financial position, remember we need to do property, plant, and equipment. They're working for this. We need to get property, plant, and equipment, not equity. Property, plant, and equipment. So there were various assets based on note 2. There was land. Land was revalued to 175. Land doesn't depreciate, it appreciates. And there was building. Remember that it was 80,000 minus the depreciation was based on the remaining useful life after evaluation. It was 2286. We used 35 years. Divided by this. So 80,000 minus 2286. So that is 77,714. And there was plant. There is plant. So remember that it was 156,000. So 156,000 minus accumulated depreciation minus depreciation for the year, reducing balance. 156 minus 26, which is accumulated depreciation minus depreciation for the year. So that is 110, 500. So that is the 110, 500. So the total there is the total will be 363,214. So you'll come here and say farm what? Farmland Limited. Statement of financial position. As at 31st October 2024. Shillings in thousands. Assets. Assets. So non-current assets. For property, plant and equipment, already we know it's 363, 214. 363, 214. Then there is from the trial balance, there is a last item, long-term investments. Investments, long-term. So that is an intangible. It was 90,000. Then there was that right under lease. Remember that you were given the right to use the asset, the finance lease, right of use. Right of use asset. Remember for the lease, the lease, you were given the right, the right to use what? To use that relevant asset. So that is an intangible asset. We do not be included here. So right of use asset. We did an analysis. It was 91. After determining for the payments of the 4 years, plus the initial payments of 22,000, we got 91 something. 91,737, and there was depreciation of, that is amortization, like more of amortization. It lost value by 18,347. It lost value by 18,347. So you have to say 91,737 minus 18,347. So that is 73,390. So this total is this total is 526,604. We continue here. We continue to current assets. Closing inventory, not one. Inventory closing, it was 43 something. 43,200. Inventory, then we have receivables, debtors from the trial balance. The receivable is 63,200. So up to that point, we have total assets. So the total assets there is plus 43,200 plus 63. So that is 633,004. Equities and liabilities. We talk about equity. I remember there was ordinary share capital. There was retained profit or earnings. And there was revaluation. So share premium, it was 150,000. Retained, it was, I think, it was 218 what? From the statement of changes in equity. From our statement of changes in equity, we did this. Our retained earnings was, the balance is carried down, 218 to 760. And this one was 45,000. With the total was 43 something, 440 what? 150,000 plus 218, 760 plus 45,000. It was 413, 760. Total equity. The non-current liabilities. The non-current liabilities. The 8% loan, that is 150,000. It was 150 out of 50. It was 50, not 150. It was 50,000. 50,000. Then there was deferred tax, which increased it to what? Remember, deferred tax is a long-term liability. It increased to 14,100. From the additional information, it increased to 2. From 12 something to 14. So we go with the 14. Then for the long-term risk from lease obligation, remember I said the 54 something. It was 54. 711. From the lease amortization schedule. Lease amortization schedule. Then current liabilities. Payables. Trade payables. So trade payables is 33,400. Bank overdraft. The bank overdraft is the bank OD. The bank overdraft. The bank overdraft is, sorry for the interruption. So the bank overdraft was there bank overdraft? The bank balance, which is on the credit side. Remember that the bank balance is supposed to be on the debit side. But now we have a bank balance with a credit balance of 15,400. The bank balance with a credit, it's on the credit side. That is an overdraft. It's on the credit side. It's a bank overdraft. Then we have current tax from the additional information. So that is an obligation because it has not yet been paid. 28,300. The current tax. Then the lease obligation from the amortization schedule. The 22,000, we said it will be paid for a period not exceeding 12 months. It's paid in advance. That is a current liability. That is a current liability. Then accrued interest. The accrued interest loan. If you check on your question, loan interest paid is 2K. The total interest was 333. The one which is paid is 2,000 from the trial balance. That is what they said. Loan interest paid 2,000, but the total interest on the loan notes, the total interest, the 8% times 50,000 times 10 over 12, we got 3,333. 2,000 has been paid. So the balance of 1,000, 333 is not yet paid. That balance is not yet done what? Paid. So if we look for the total, we read balance. We read balance. So is there any difference? So that we check maybe something which we have not captured. Is there a difference? You are getting equities and liability are thought of? Guys, you have been silent the whole time. So the total equities and liabilities is?
$633,004.
633.
Yes.
Yes.
It's balancing, eh?
Yes.
Oh, so it's okay. Everything's fine. That is what you mean, eh? Any question? Because now I think you have understood. Any query? Any question? No question? Hmm? No question? All right. So 633,004. So total equities and what? Total equities and liabilities. Total equities and liabilities. So I will look for one more question. We do it. I will look for one more. So that we do it as our second illustration. There's something I'm confirming so that I'm sure of everything is okay. Everything is fine. I've confirmed that. It's balancing. So we have total assets and the total equities and what? Total equities and liabilities. So that is how you were supposed to get this question, 20 marks. So what you need to understand is on how to prepare your statement of profit or loss with the main thing after you have analyzed your additional informations. At the end, you need to know that expenses are supposed to be classified under either cost of sales, administrative cost, distribution, and finance. Very important because you have to follow that format. So that is a rule. That is a rule according to S1. Now you need to understand. You need to understand about the statement of changes in equity. That format I drew. I think now I think I tried to fix everything. Even those items which were not present. So you understand how a statement of changes in equity looks like. Then when doing this statement of financial position, the property, plant, and equipment. For the property, plant, and equipment, you have to do it first. Then you go ahead now to do your statement. So that is it for today. So that is it for today. So it's okay. So we meet next time when I will be doing another question. For what?
Maybe A question, Mwalimu, how will this be marked? I see in your other videos, at least you give clues how this will be marked. This last statement, thank you.
Or how will that be marked? Uh-huh. So I think you have the name. So, but I can be able to tell you how it was marked. How I printed the name. I have it. I have it. So I can mention how it's marked. You could have even reminded me. I show you how they marked the other two statements. Because already I've cleared. But we can look at this one. How it's marked. Mhm. As it's here. So for this statement of financial position, because it's the one we already have, it was marked this way. Question number 4. Statement of financial position. This one, they were marking any 8 at once. So they were marking this one, this way. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. So that's 16 entries. Any 8. They multiply by 1, you get your 8. Any 8. Out of this, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. Any correct 8. Any correct 8. Any correct 8. But for the income statement, they were looking for any 4. For the income statement, multiply by 2, you get your 8. For the statement of profit or loss. And for the statement of changes in equity, out of those items you have, any 4. Multiply by 1, you get 4. For the income statement, any 4. They multiply by 2, you get your 8. I think that is okay. I think you have understood how the marking was done for this.
I have a question.
Mm-hmm.
Do they mark the values or the procedures on how you have arranged your work?
No, FR, when they mark FR, you see all those workings I did, they don't earn you any mark. When FR is marked, they mark these entries. You see, what is needed? The examiner needs what? Statement of profit or loss. Statement of changes in equity. Statement of financial position. Those are the ones which are marked. Those workings, that is your work. Me, if I'm marking your statement of financial position, I come here and see, I look at property, plant, and equipment. Is this one correct? Is this correct? Is this correct? Is this? So I check. Out of the 16, do you have any? 8. Correct. I multiply by 1, you get 8. Your workings is your workings. Workings in a file are never marked. They don't earn you any mark. This is not like financial management. Here we mark the final entries. That is why I always tell my students that when you are doing your exam, make sure that you minimize your workings to your level best. You minimize that is why consolidation, I always do consolidation. I do those statements direct as I continue with the workings. I don't do fast workings because there's someone who will tell you open T accounts. Until you will open those T accounts, you find 2 hours is over. You have done one question. So you minimize your workings. In exam, by then in FR, the one which maybe needs a lot of time to do the workings is published. For the other questions, they are just done as the workings, you do them as you continue with what is required by the examiner. Workings are never marked. They mark the final entries. Is that okay?
Okay, and for additional information, Will you
Additional
show your
information?
for additional information? Will you show you are working in your booklets, exam booklets?
So you can show, but no mark for that. It's not a must you show.
So
But
it's
for
not
you
a
to do
must.
the statement, you have to. Where will you do the workings? Because you don't have another. You don't have extra papers to use in your exam. You have to use the answer book, the answer sheet booklet, for you to do the other workings. But if you can do without workings and come and give me this, I will mark. You have come and you have given me the statement of financial position. I will mark. Statement of changes in equity. I will mark. Statement of the statement of profit or loss. I will mark. That is why sometimes when time is not on your side, remember this one can be done in less than 15 minutes. Let's say you have done questions, then 15 minutes to the end of the exam. You have realized that you have not done published. What you do, go and draw that format without workings of statement of profit or loss and for statement of financial position. Like now here, for me to do statement of financial position, for me to get 8 marks, I can get 8 marks without workings. Wrong term investment, no working needed. Inventory, no working. Receivable, no working. I will come and write this. I skip. I don't post anything. This one, no working. This one, no working. This one, no working. This, no working. Statement of financial position, you will score everything. You will score the eight without doing any workings. Maybe the income statement is the one which needs a bit of workings. But even if in that income statement, remember there was admin. It never needed any workings. There was a distribution. There's tax. Once you fix, I will mark. So it's not a must you do. So anyway, what you need to understand, you need to minimize your workings to your level best due to time. Workings are never marked in your financial reporting. We mark the final statements which are required, which are the requirements. Is that okay? All right.
Yes.
We have come to the end of the session today. I think I will arrange another session before we meet next week. We do another question. Have a good night.
Same to you.